Okay, good evening, guys. Welcome to another live trading webinar. My name's Steve Ruffley. Got to go through another really crucial part of trading success tonight, and that's all time frame trading. So this is really kind of taking a view of the markets from the higher time frames, zooming in to picking your entry point, and then figuring out how you kind of get back into the markets and and kind of put the more important entry points and then balance them out with the more important exit points, because that really is one of the main arts of trading. As I've said it once, I will say it a million times probably over these webinars, is that trading's not about being right, it's about being at the right time. If you want to have the right kind of opinion on the market, that helps. But that's really an investing mentality. What we're trying to do is use that overall bigger picture and to zoom down to the smaller time frames and to get our points of interest and almost not call things support and resistance anymore, call them points of attraction. So we can see where the market's going to go in the short term, get a small term trade on, minimize our risk, maximize our profits. And that really is a key to trading. So, all time frame trading. Now, when you think about trading, time is generally your enemy. And that just really kind of means that if you're trying to look to be right and hold trades for too long, then the chances are things are going to go against you. And, that's much more of an investing mindset. What you're trying to do is lock away your capital for a specified amount of time, and you expect that to grow. So you're investing in your position. You're investing for a specific amount of time. When you're trading, it's a very different approach. You're trying to capitalize on movement, and you're trying to also remain fairly market neutral. You're buying when the market's low. You're selling when the market's high. Okay, so I guess you're fighting with time in that respect. That you're only right at the right time, but you're not locking away your money and seeing your P&L fluctuate. And this is the real difference between that whole longer-term investing and short-term trading. With longer term investing, you're expecting something generally to go up because that's the nature, the mentality. While the stock markets keep going up, it's because people expect them to. Pension funds need to make money. Investors need to see return on their initial investment. Companies need to keep making money. Pushing that share price up. That's how business grows. So the whole investing mentality is all really from the long side, and you're trying to stay in the markets as long as you can. Now, really from the short side of the market, buying and selling, when you talk about scalping or you talk about, short-term intraday trading, some of my trades can last, a matter of seconds, 30 seconds. Some can last a little bit longer. We're talking on maybe 15 minutes an hour, but generally they'll never last more than a few hours, and certainly won't last overnight for more than a day. If they are, the majority of the time, if I'm holding overnight trades, is because I'm wrong. And I'm holding on to a trade and I'm hoping it's going to come back. So that's something that I, over the years, have ironed out of my trading, and certainly something I've learned from, is that I don't hold positions. Now, I only have one particular long-term trade on, and that's what I've had on for about 6-7 months now, and that's a long of the pound against various currencies, and that's really one of the kind of few longer term views I've taken. And that's a combination of the fundamentals and technicals that we've gone over in previous webinars. My view on Brexit, my view that the pound is oversold, and really no matter what happens, as long as it's not a hard Brexit, which I can't really see happening, that the pound being so oversold is going to come back. So there's lots of value to be had. But generally, when I'm in the markets for my trading approach, all I'm looking for is maybe the 15-minute charts, the 5-minute charts, looking for those 15, 20, 25 pip moves. I mean, trading big size, the one I trade like $300, $400, $500 a point. You don't need a lot of movement to make good money. So really, what we're trying to get into our mindset is not trying to be right. We're just trying to make money from trading, and that's the first thing that people say to me when I say, what do you want to achieve from trading? People say, I want to be rich, I want to make money. And that all has to be quantifiable. So that just means that if you want to make money in the markets, then you need to understand how much what you're willing to make versus how much you're willing to lose. So in a short-term trading strategy, you can look at it in different ways. You can look at it, I want to make 10, 15, 20 pips. So on $10 a point, you can make, $150, $200. That might be enough for you. That's fine. Or you can up your size and make, greater amounts of money. If you say you want to be rich, then you can't really quantify that, because rich is different things to different people, and you're never going to get a situation where every trade you do in short-term trading is a winner. It's all about percentages, and it's quite a simple set of calculations when you talk about intraday trading. You have to almost work backwards. Start with a yearly target and then split that down into 12 months, and then from your 12 months, there's each individual month set weekly targets. Yeah, and then for them weekly, set daily targets so you know how much you can make or lose in a day. Yeah, and how much then you're going to have to make or lose in the week to be profitable, and then times that up how many times you have to do right or wrong in the number of weeks to make your monthly total. So in short-term trading, that's a much harder thing to do than investing. Investing, you're talking about holding something for months, years, perhaps even decades, and you're looking for an annual percentage, kind of return. Whereas in trading, you're looking for more that instant hit, but because you're trading so much more, that has to be controlled. So trading is no right or wrong approach. People think there's this holy grail of technical analysis, fundamental analysis, and there really isn't. Over the years, I've created many algorithms. I've created, different software packages for MT4, for Metastock. They're just all combinations of things that have helped me interpret the markets. And this is the great thing about trading, is that we all look at the markets in our own way, and we're all trying to get that edge. It really flips back on its head. If you're the only person looking at a certain strategy, you're the only person, that's out there, trying to get that edge, then you're not really benefiting from the self-fulfilling nature of technical analysis. Now, technical analysis works because the majority of people look at something and they base a decision on something, and therefore then the market moves. And that's why a lot of people use moving averages, or they use Bollinger Bands, or things like RSI, candlestick charts. The more people that look at it, the more likely they are to do the same thing, and the market's going to move. This is a dual-edged sword when you're talking about technical analysis, because if you're looking at it and everyone's looking at the same thing and we're all expected to do the same thing, then the market therefore then should. Well, that's the theory. But if you know this and I know this, then the big boys know this. Your Goldman Sachs, your hedge funds, etc., etc., the algorithms that are running in the markets. So what they'll do in the short term is know what you're looking at. They'll then factor in your risk profile, which is a short-term trader is relatively small. They'll move the markets to the extreme very quickly, try and shake out the weak positions, and then they will move in the direction we all know it was going to go, and that will work. So the whole point about understanding the bigger picture is figuring out what those pain points can be, because where the market has been in the past, it will help you to visualize and help you to get an idea of where the market is going to move to in the future. So it's always a constant battle between looking back to what has actually happened in the charts to then thinking about what could happen, taking in the fundamentals, taking in the sentiment, and then putting in that missing ingredient that the most people out there will tell you about is that pain. The markets are there really is their main purpose to inflict pain on the short-term trader, to make you think you're wrong at every point. Now that's just the way markets work. Again, it's purely out there to make money, and people are trading to make money. It's all about who's got the deepest pockets, who's got the most aggression. And if you don't want to be involved in that, then don't be a short-term trader. This is the whole point. If you want to take all that stress out, then just be a longer-term investor. Give your money to a broker, or take a position long or short and just sit on it. Yeah. So what you're trying to figure out is how all these moving parts put together, and once you kind of get that idea, then you're building a strategy. So the whole point of when I did my software packages, and I'll show you iView charts at the end, which I use for my own funds, etc. I tried to get a consistent view of how the markets are moving. So I have things that I use like Bollinger Bands, Fibonacci, points of interest, and all the different time frames all put together on my charts, and they're all set in the same way. Now they're set in the same way because they run off percentages, they run off previous trading successes that I've had. They've just run off the numbers. So if each market is set up that way, at least I know I've got a constant that when I'm looking at the market, I know how it's set up. So if it's fitting into my view of the market, it's a tick. If I then see something that I might want to trade based upon some news, some sentiment, it's another tick. Yeah, and then I get drawn into that market because I feel I'm getting an edge. Now, if I don't tick those boxes and I don't feel that I'm getting, what I need out of that market, then I'll leave it alone. There's something else to trade. Now, this is one of the real skills you have to learn as a trader. You don't always have to trade the same product, but then you don't have to trade every product. Just because it's moving doesn't mean you're going to make money from it. So it's really coming back to that discipline as a trader. And you have to kind of say to yourself, well, I'm trading gold. Okay, I understand what the dollar's doing. The dollar's moving down for reasons X, Y, and Z, hitting some technical levels. Therefore, I can see gold, if it finds some significant support around these regions, I know it can be bought up to this region. And you're starting to justify a reason for getting in a trade. If you're just buying and selling because it's moving, then how are you going to get the consistency? How are you going to replicate that kind of trade? And that's all trading is. Finding something you're confident in, finding some way of interacting with the markets in a way that you feel is going to be profitable to you, and then just repeating it. And again, you can trade this way in any market. You can buy and sell any market, but you have to have some reasons for doing it. If you're just trading because A, you want to make money and you haven't set goals, you're probably going to lose. Or B, the market's moving, you just want to get in because it is, and you don't really know why. Again, you're probably going to lose. So it's just cutting these little simple mistakes out that a lot of traders, fall into, at most levels as a trader. And once you cut these out, you're going to see that you're going to be much more profitable, and that over the long term you're going to be much more consistent. And consistency really is the key to being a good intraday trader. So where levels come from? So we talked about the past. So like anything in life, what happened in the past eventually, should lead us, to an indication of what's going to happen in the future. So what we're trying to figure out is this all time frame structure. So it means starting with the highest time frame, that you're comfortable with, and moving down. And that just means that, you've got access to infinite data. So you can certainly go back 10 years in a chart. But, if you go back 10 years in a chart, you're probably going to miss out some of that fundamental news, some of that sentiment is going too far back. So, you don't have things like Donald Trump, don't have, the tensions with Russia, Korea, all the things that have been blown up over the last few years. You won't have quantitative easing. You won't have 10 years of ultra low interest rates, etc., etc. So for me, really, when I'm looking on the charts, I generally start on the monthly time frame and maybe look at about 12 to 18 months of data. Okay, that'll give me significant highs and lows. That'll give me the general direction. And from that point, I can start to build down and drill down into the more intraday things, the more kind of intraday market that are going to give us those more, kind of targeted, entry and exit points. But as I'll go through it, it'll start to make more sense of how you build a picture of where the market's been, and therefore when you look at the markets right now, where it can go. So Fibonacci, is the something we did in that previous webinar last week. Fibonacci is something that I've used really since day one. So a big part of my book, it's in every algorithm, and it's really my go-to piece of kind of charting information. I understand that if a market has gone from a significant low to a significant high, this strong directional up move, as I've stated before, 80% of the time a strong directional move, as long as it doesn't make a new low or new high, will retrace to 50%. So we see the example, this is a monthly chart, a nice up move, the market moves down, and it gets back to that all-important 50%. Okay, so 80% of the time a market will do that. So you've got to wait a long time to see that play out from the low to the high, set in stone, market moves down. So if you're selling it, for instance, you have to wait, a good, 8, 9, 10, 12 months for it to get back to that 50%. And you might want to wait that long. But what it gives you in the main point is that you have a 50%, which then acts as a pivot point. So as the market hasn't made a new low or made a new high, the pivot point from this point will start to be, again, a point of attraction. We hold above it, we get to the 38.2, 23.6, and make a new high. If we hold below it, get to the 61.8, down to the 100, make a new low. So for that 50%, you've got a 50-50 chance of it going up, 50 chance of it going down, but you've got something, as in you've got some levels and some idea. If you hold above the pivot, you're more likely to make new highs. If you hold below it, you're more likely to make new lows. Okay, so you're taking that view, taking that sentiment, taking that information, and that's just one part of the picture. And from there, we move on. Okay, so once we've done that, okay, what we can do is put other straight line levels of support and resistance in. We're still in a monthly time frame, so we look for areas of interest. Okay, and you can just draw these things free line. A lot of people say, how do you draw your levels of support and resistance? And it goes back to that self-fulfilling prophecy. If it looks like it's an area of interest, where the market's had some decision points, or it's targeted or stayed to, for any period of time, again, remember these is monthly, then it's going to be of interest later on. So this down here, lots of points, points of attraction where the candlesticks are grouping towards, and then the extremes of the markets down here. So what you've got is your monthly Fibonacci, your pivot point, and now you've got some monthly points of attraction. Again, because what we're going to go from this point as we zoom down, we don't call them support, we don't call them resistance, because for intraday trading, they're just where the market's been in the past. So it's a point of attraction in the future. Again, it's the way we talk about trading, the way we get involved. If you talk about support and resistance, then you can be buying support and selling resistance. That might be the way the market's moving. If you want to stay more neutral for your intraday type of trading and more aggressive, just call it a point of attraction. So you can buy it or sell it without that predetermined bias. So yeah, it's all these little tips and tricks, that get you in that psychological mood, that psychological edge. And when you talk about, being, in the zone of trading, it means that you're buying when it's low, you're selling when it's high, you're in the markets for a relatively short period of time, and you're just banking money, limited risk, banking money. And you do that 10-15 times a day. All of a sudden, if you can compound that over weeks or months, you're making really good money. Okay, and that's how trading works. So we're building a picture up for the monthly view, then we're going to zoom down to find out what's more kind of relevant. So after that is the weeklies. So in the weeklies, the same scenario. If you wanted to do a more recent Fibonacci, maybe this low to this high, you get another 50% pivot. Yeah, but maybe we'll save that for an hourly chart or something a little bit more kind of, relevant to what we're looking for. But the straight lines of attraction, again, weekly. Yeah, you've got these points in, just put them in a different color. All of a sudden, you're building a picture. What's happening in the months, what's happening in the weeks, then obviously the daily. Yeah, different color still. And all of a sudden, you've got this framework all building up. Yeah, this was interesting. Yeah, the market pivot around here on dailies. So you have monthly pivot, monthly points of attraction, weekly points of attraction, daily points of attraction. Yeah, so all these things are bringing relevance to what happened in the past, and therefore predicting, because that's where the money's made. Yeah, in the past, when you're trading longer term or investing, this is where you're going to make the money in the future. Yeah, here. Yeah, well, to right hand side of the chart. So all of a sudden you've got pivot above, next point of attraction. Yeah, so the market breaks up quickly, you can get out here, and that would be your exit point. Yeah, and that might be enough, to start you getting off in your trading journey, to start you making money, to give you an idea. Again, the more information you have and the more you can replicate these things, the easier it is. So to do a chart from a monthly, weekly, daily, you can have a chart set up in less than 5 minutes. Okay, if you have automated systems like I have, you can have a chart or 10 charts set up in under 5 seconds. Yeah, that's how easy it is to do. And again, it's about being ready for the markets, being ready for what the opportunities are going to be. You don't want to be drawing charts, and these lines in mid-session when the markets are opening. You should be concentrating all your efforts on trading. So if you do a little bit of research beforehand, even that 5 minutes can set you apart. Trading doesn't have to be difficult. It doesn't have to be all time, consuming. You just have to be prepared. So all these kind of hacks and these kind of shortcuts, of what you're going to get from me from just 15 years of trading, charting, and teaching people how to trade for themselves. So what we've got when it comes down to it is zoom the chart out, and we're on that daily view still, and you see that all of a sudden stick some Bollinger Bands on. You've got your Fibonacci, you've got your points of attraction from the monthly, the weekly, and the daily, and you've got a framework. Okay, so that framework, you started on the monthly, went all the way down to the dailies. This is gold, so you can see to yourself, well, gold here, if it holds below the kind of 1326 mark, and then gets below that 50% pivot, because my view on gold is, is relatively bearish, because with interest rates, in the US going up, the dollar gets, more expensive, gold becomes more expensive, people sell it off, there's less, need for a safe haven environment, etc., etc. Again, and then what we see is the market can get to that overall monthly 50% that we saw before, and any kind of significant breaks, you could be buying some profit back at 127, then you've got all these other targets which the market can go to. So really, again, I mean, that's obviously I've drawn that particular kind of view from my longer term sentiment, but as the market moving, if we go into a shorter time frame, still we can take our positions from that. So as I say, we're looking at a trend or market neutral kind of position. So as we explained before, if you're going to invest, then you're going to want to go with a trend. That's the longer term view. And even in short term trading, it is safest to go with the trend. But then you have to understand, what that trend is. If you're only looking for 5, 10, 15, 20 pips, you can go against the trend for profit taking and small, kind of counter trend trades. Yeah, but it has to be in, again, this kind of controlled manner with your short-term trading. So what we're looking for when we're trading with the trend is just understanding how you want to interact with the markets. Yeah, if the trend is up, you buy low. If the trend is down, you sell high. And it sounds obvious, but you'd be amazed how many people get caught in the markets. And it's because they go back to that, I can buy, I can sell, I can do whatever I want. Okay, but then because you don't have the discipline, all you end up doing is buying and selling, and then your losses cancel out your gains. So for me, the way I get around that is that yes, I do try and be market neutral, and I teach people to market neutral in that you can buy and sell, but it doesn't necessarily mean you have to buy and sell in the same market all the time. I've stuck to some pretty core principles in the markets I trade. I will sell gold high, I'll sell the euro high, I'll buy the dollar low, I'll buy the pound low, I'll buy the indices low. Okay, so what I don't do is the opposite. So unless something significant comes out from the news or it's a massive level, I would say 80 to 90% of my trades with that bias. So if I see the euro is going up, I'll be happy to sell it, average into trades, and hold my aggressive shorts in that market because that fits in with my trade setup. If the euro's low, I don't really ever buy it. And it's not because I don't think it's going to go up. It's just after years and years and years, I'm not trying to take too much out of the markets. I'm not trying to be right all the time. I hedge my bets. I hedge my experience. I hedge my account size, my leverage, and I do what has made me money. So I don't buy the euro low. And it's not because I don't think there's value down there. It just doesn't fit in with my mindset, my trading mentality. So that's just the way it is. You can buy and sell any market you want. You can be involved in any market you want as many times as you want. That's your prerogative. All I'm saying to you is the way I feel comfortable in the markets is buying the pound low, selling the euro high, selling gold high, and these kind of things. I've just, I get the repetition out of that. So again, if I see my trade setups happening, I'm happy to get into the markets. And then again, I can maybe take a little bit more risk on by averaging into trades because I've got the confidence that my trades have worked in the past. And I've also got the track record that, of what I have done in the past has made me money. So this is the whole point. I'm not teaching you how to trade like me. And it's not all about I am always successful and I always make money. Obviously I can't any trader. I have losing positions, but I have less losing trades than I have winning trades. And that's why I'm still here 15 years later. So again, it's just when you keep talking about these things, and that's why I always do my webinars live, because it always reminds me, to kind of tell you things from my experience and what I've helped other people. Because a lot of people, they always feel like they need, a set of rules, or they want to follow someone else's successful trading system. And it doesn't work like that. You have to figure out how you interact with the markets, how the markets push your buttons, and what you feel comfortable with. Yeah, and that might be very different values than I have, but doesn't still mean we can have the same or differing opinions. And we can't all still make money in the markets. The whole point is about my webinars and why I've been so successful teaching people is I just give little bits of nuggets and I try and explain them the same thing sometimes in many, many different ways because you never know what's going to stick with people. And it's that light bulb moment where people goes, I've never actually had it described that way. And you're exactly right. I think like this and I do that and I lose money. So I think in this way and do that, I can make money. Yeah, and that's sometimes all it takes. A lot of people, you can read any book on the internet, you can watch any webinar, you can spend any amount of money on courses. They won't tell you anything really that you don't know from the basics. And that's why I don't charge for my education. My education just comes from me. And as I say, if you want to kind of join my mentoring kind of schemes, it's also free. I'm not going to get to the end of this course and try and flog you, some course for $7,000 or whatever. And you know what, maybe I should. Because people tend to not trust me and say, what are you going to get out of this, Steve? You can't just work for free. Well, so I give an hour a week away from free. I can manage that, guys. It's not very difficult. The whole point is if you invest in yourself and you open an account with CMC and start to trade for them, they're a trusted broker, they're listed on the stock exchange. And then if you start to make money through my mentoring, down the line, I make money. It's as simple as that. I'm an IB, an introducing broker. It's on the website. You can find it out, there's no miracle. And the whole point is it works for me. I'm free. So you can't say that I'm giving you bad advice or I'm teaching you wrong because it doesn't work like that. If I'm giving you my time for free, then you have to go away and do something with it. You have to be a good trader. You have to be successful. If I'm not teaching the right way, you don't trade and you don't have longevity in the markets, I don't make any money. So it's kind of that trust thing. It's that kind of we're in it together. If you can't make any money from trading, then I've tried my best. I've given you all the information that you've needed. And I said, this the difference for me is I've been doing this in the UK for over, for over 7 years. I've been the chief market strategist of Intertrader in London, and I've taught thousands of people. I don't need anybody to question my credibility. It's there. I have taught thousands of people to trade. I have made, plenty of millionaires. You can Google these other people, these Timothy Sykes and all these other different people, like this kind of stuff. None of them else offers it for free. There's only me, yeah, Steve Ruffley, that's made his money trading, yeah, that can give you my time for free. Yeah, and then if you go on to be a successful trader, and it's the bigger traders that I work with that tend to do well, that can fund big accounts because they can take more pain. They can trade more aggressively. When they write, they're making 10, 15, 20, $30,000 at a time. And this is what it's all about. If you know the rules of the game, you know how to play it, how to match it all up, then anyone can be successful at trading. But you have to be right in your own mindset. You have to have all the different combinations of things put together, as in your fundamentals, your technicals, and a bank balance that's going to support your goals and targets. Yeah, and once you put these things together, it's actually relatively easy for me to make you a better and consistent trader. That's what I do. Okay, so going back to that whole idea of buying low and sell high, if you can make your trading strategy as simple as that, then you'd be a very good, successful trader. It's all the other things that happen in the market that make it almost impossible to be as black and white as you buy and sell just because that's what you should do. Yeah, you have to have that confirmation, that bigger picture idea. There's all these different ways that the markets will do things to try and confuse you. So market neutral, as I've said, that you can still trade with the trend and be market neutral, just meaning you're still just looking for value essentially. If the market's high, it might not be high in all-time highs. It might just be high on that 15-minute candle or that hourly candle. So what we're trying to do is take the trend into consideration, but be comfortable with the levels of the higher time frames and be comfortable with what's happening in the markets around us and just buy and sell. Because think about it, nothing's going to go up or down indefinitely. Yeah, if something goes up or down in a very quick, space of time, it's going to snap back and retrace to some point because people take profit. So if something goes up 200 pips in a straight line, it's going to retrace at least 20, 30 because somebody's going to be winning in that position and getting out, taking the profit. And other people are going to be wrong in that position. Yeah. So, the markets can never just move. So you can go with the trend, and when the trend snaps back, you can still be market neutral and sell in a buying market and still logically make some money because we know that nothing goes up or down forever. So again, it's taking this market neutral kind of trading mentality, using your other indicators, using the sentiment, using just what the market is giving to you right there and thinking, is this the right time to buy? Has it gone too far up? If it's gone too far up, shall I wait till it comes down and buy it again? Or if it's gone too far up, are people going to take quick profit? Then should I sell into that strength? Yeah, for just a very, very short period of time. And this is the difficulty between investing and trading, and that short-term view and that long-term view. You've got to ask yourself in a relatively short space of time, maybe 4, 5, 6 different scenarios, and then decide what is the right trade. Get in the trade, take your risk, get your profit out, and then think again. So that's what makes trading very exciting from that respect, because there's lots of variables, lots of things going on. You've got to be right at the right time, get in and get out. But that's what also can make it very stressful, because if you're not set up with these all time frame view, you don't know where the market could go to in very quick periods of time. You find yourself just getting chopped out. Yeah, especially if you don't, if you put stops into the market, you buy with a stop, you can get stopped out for a loss. If you're not in the right kind of mindset, you're not trading in the zone, you don't have everything set up correctly before the market starts to move, you can find it very difficult. So that again is the main difference between that investing and trading mentality. It's the time and the number of decisions you have to make in a very short period of time. So again, the market neutral thing, it just really, it doesn't make any difference, with the markets right now, because there just is so much movement. The market neutral thing used to be a lot more prevalent when the markets are much more stable because of the volatility right now. Anything can happen. Trump can tweet, Korea can, launch a nuclear weapon, anything, literally anything can happen. There's so much news now, and there's so many kind of people trading that you're always tending to be as an intraday trader market neutral, because you can buy with a piece of news, and then within the next kind of 30 seconds the news has been discounted and the market snaps all the way back. So it really is just kind of understanding that you don't have to be right, as in you don't have to buy the bottom of the market, sell the top to make money. You can be involved in the noise, you can be involved in that volatility, you can buy or sell in that volatility as long as you're comfortable of what the markets are trying to achieve for that period of time that you're involved, right? So some of the best short-term trades occur at the extremes of the market. So when something hits an extreme point of resistance and goes up, you can guarantee that people are going to say, well, that's going to be the highest the market will go, and it will go that extra 20-30 pips in no time at all, because the market knows that's where people are going to feel pain. So the market goes up, short squeeze, people get out, the market then comes down, but you've missed the trade. Yeah, and this is really by looking at the old time frame method of trading, as you can see where these extremes of the markets are, because intraday, the hourly candles are open. Yeah, so every hour they close, but in a respect, they're still open. Yeah, it's only when they close in a daily they're set in stone. So when the markets are open, you have to have these higher time frame points of attraction where the market has had them extremes and hit those extremes previously. Yeah, and that becomes your framework. Okay, so again, it's just a way of getting that consistency, getting those levels in play that you can put into any market, and then you can find out where these extremes might be, and where your pain kind of thresholds and points in the market may be. So again, looking from the FTSE on on the kind of daily perspective, the market's going up. Okay, so nice and bullish. Then you look at the hourly. Okay, fine. Well, the market's hit a top and come back down. So in this respect, you've got your extremes of the market here on the high side, extremes on the low side, your 50% pivot. So you can buy low or you can sell high. There's still money to be made. I mean, remember, these are just hourly candles. So if you buy the low here and hold it for an hour, yeah, there's money to be made. If you sell the high, there's money to be made. You don't necessarily have to be right on the trend. There's actually pretty much 50-50 opportunity to buy and sell and still make money. 50%. So again, with these lines already in play, yeah, you see when the market comes down aggressively, rejects, that's an easy candlestick pattern there. Okay, your rejection, your long tail, market closes above support, and then again, all the way back up. What does it get back to? The 50%. So another target. Again, the 5 minutes, you start to look at, your indicators, your oscillators. So in here, the L is saying sell, get to a high point, good sell point. Here, green, market saying the market's, oversold, it's too low. You got to a buying point. Okay, so you buy even here, or even the next candle when it opens, look how much profit you've got. You've got an hour and 15 minutes just to hold on to make all that profit. Again, the 5 minute chart's no real kind of sentiment bias, but you can buy it low. Yeah, you can sell it high. So all the point of that is, the market in its overall trend is bullish. But actually, when you look and drill down to the hourly, 15-minute and 5 minutes, you have just as much opportunity to sell it as you do to buy it, to make your 10, 15, 20 pips. And you can do that a couple of times. A couple of times a day in each market, banking 20, 30 pips. All you have to do is that 2 or 3 times in 2 or 3 different markets. Then again, you're making good money. So again, it's just trying to remain focused on what the end goal is, and that's making money. It's not being focused on being right, buying the absolute low and selling the absolute high. It's leveraging up your money, trading the right kind of size, minimizing your risk, and banking that profit. So again, what we're looking for is the daily trend reversal signal, hourly reversal signal, 15-minute that rejection wick that we talked about, 5-minute 50% retracement. So we've got opportunities to both buy and sell. So that just means, even when the market here is telling us we're overbought, yeah, overall, yeah, if you'd held the trend and bought it, very good. You'd have done it. But what we see, is a bearish Marabuzo here on the daily trend. Yeah, we see the market's overbought on the daily. So that might be, again, going into that mindset of when we get to the lower time frames, the hourly, 15-minute and 5-minute, maybe if the market does spike up quickly, there is that opportunity to potentially sell. So this is the difficult thing you've got to marry out. Again, I do these things and take these things for granted because I've done them for so long. I'll take an individual product, I'll go from the monthly down to the dailies, get my hourly and 15 minutes up, my charts are set up. I know exactly, how I'm positioned in my head, technically, fundamentally, and what's going to drive my decisions. This is where you've got to get to. What's going to drive your decisions? Where do you start? And I said, if you start with the higher time frame and get that get that framework in place, at least you've got the kind of technical aspect of where you can see the extremes of the markets have been in the past and where the markets can move to when your trades are open in the day. So again, go from that, overbought again, we see double top, bit of analysis, support here. So again, areas to buy and sell, but if you're going for your overbought, which goes on from the daily, dragging that sentiment through, again, as the market hits these expansion points, 50, you know, at that top point of the extension of the Fibonacci. As the market comes down, you can sell it, and where's your kind of, you know, next point of interest, your 50% pivot, which is always a dotted white line, then down to support. So again, it's building a picture of what's happening. You know, again, lots of higher shadows, you know, so the market on the low points got some green. Green indicates buying, obviously. So market hits these low points, goes back up. Was it heading towards the 50%? Where's this heading to? The 50%. Yeah, but lots of higher shadows. So the market is also carrying on from that daily and weekly, that daily and hourly sentiment that, you know, there is still opportunities to sell, and there's plenty of red candles. But again, you know, you need that trigger. You need to be selling high. So you sell high here, you sell high here, red, red, red. Yeah, sell high here, bang, market comes down, red to support. So he's picking the point at the right time. So what you don't want to do, you know, is be selling the market at the wrong point, because, you know, if you start selling the market, you know, here, and the market goes, oh, right, we're going to break support and carry on going down. Well, it doesn't. The market, you know, hits the support, stops, bang, you're going to get stopped out. So you might be right for a couple of ticks, but as the market turns very quickly, you're going to be, you know, you're not going to have enough time really to get out. So it's picking the point of selling high, so you can sell out for profit anytime you want before it turns, and then you're buying, it's going back up. So it's all about finding those extremes of the market, marrying it up with the right kind of time frame, making sure you understand the size you trade versus your risk profile. And as you start to do that day in, day out, you start to bank the traders, bank your profit, and you become more confident. And then confidence breeds consistency, hopefully. So again, just going back to the 5-minute chart, 50% Fibonacci retracement. Okay, the market, a little bit of green here, so you can buy towards support, get it back to that 50%, hit the extremes, market red, breaks that 50%, support becomes resistance. Again, market continues to move down. So as long as you're in at the extremes, you're understanding where the markets have been in the past, what the sentiment is, and what the indicators are telling you on the shorter time frames. You know, again, it's all about just figuring out where that value is on the time frame you're looking at. Where's that value? Where can I buy? Where can I sell? Where's the safest entry point? Where's the extreme that I get right, so I don't get stopped out by the market going against the buy or sell that I take? And that market neutral idea is that, you know, you're not just buying and selling all the time. You know, you're not being irresponsible. What you're doing is you're buying and selling and being right at the right time. So selling when it's high, you know, buying when it's low, and figuring out how that all kind of works out in the bigger picture, yeah, based on that framework you've got, but then what's actually happening right now as you're trading. So, I mean, again, you know, this 15-minute chart, just for an example, you know, from the highs and lows, there's a range, you know, between, you know, 100 and 170 pips. So even in a short-term trade, you might only be looking for 20 or 40 pips. So being market neutral, yeah, you've got 5 or 7 opportunities, and you only have to take half or less of that move to make your money. So, you know, as the market moves 170 pips, yeah, from the extreme, from the high to the low, between support and resistance, you know, you've really got 100 pips or so of meat where the majority of action's happening. So as it gets high, you can sell it down to these lower levels, yeah, 1, 2, you know, 3 times, yeah. And also, if you want to get to the absolute extremes, you can buy it back. And, you know, again, you know, these are actually probably, you know, the buys are probably better trades. But if you're staying neutral, yeah, you can sell it, buy it, sell it. Yeah, and a couple of times here, you might get caught out. You might actually, you know, be kind of buying it, you know, because you're looking for a bounce and it comes down. So out of those kind of 7 trades or potential opportunities, you might only take 5 trades, or they might be the ones that make you the money. But as I've explained to you from the start, you're not always going to make money. You're not always going to be right. But as long as you have the right kind of risk-reward ratios, even if you only get half of your trades right, you still make money. So again, selling when it's high, buying back value. That's the key. Yeah, you don't have to have the absolute extremes to make money. All you have to do is be involved in the meat of the trade, be relatively neutral, buy low, sell high, manage your risk. That is how trading is done. That's how winning is done. So the benefits really come from me. There's a short-term trader. The less time you spend in the markets, the less exposure you have. It's as simple as that. So really for me, I'm not going to stay in the markets for much more than an hour. Get involved around big data like non-farm payrolls, GDPs, etc. Go where the volatility is, and then, you know, you have the opportunity to make good money when you're in. And, you know, if you are disciplined, you know, you cut your losses short. But again, you have to figure out how many times you want to be involved in the markets yourself. You know, and people think when you're an intraday trader or a scalper that you have to be looking at minute charts, and you have to be looking at tick data, and you have to be in the markets, you know, 500 times a day. You don't. There's no way anyone's going to be right 500 times a day. Yeah, you want to be looking at the hourly chart, the 15-minute, the 5-minute chart to give yourself some breathing room. Yeah. So again, you could be in a trade from anywhere from 30 seconds to an hour, but anything less than a day is a day trader. That's a short-term intraday trader. Yeah, and if you're in and out of the markets with that higher time frame framework, with a market neutral mentality, then you're going to have a better chance of replicating success and having that key to consistency, which keeps stressing, is what you're trying to be, you know, as a trader. So once you hold positions overnight, then you're subject to all kind of different rules, you know, overnight requirements, margin requirements, and things can happen overnight. You can wake up and, you know, something globally has happened and it can really affect your position. And even if you've got a stop in, you know, unless it's a guaranteed stop, you know, the markets can take you out. So really what we're trying to figure out is, what do we want to achieve? When do we want to achieve it, and how do we want to achieve it? And that all comes from this whole higher time frame mentality framework, and then understanding of the market neutral and buying and selling, getting that value. So again, trade with a trend. That is something, you know, you want to do if you're more from investing mentality. So the point of buying and selling into a trend, you know, is you want to do it early. You know, a lot of people say if you've spotted a trend, it's already too late. How many people spotted a trend in Bitcoin, bought Bitcoin 15, 16, 17,000, and now, you know, stirring the back of, you know, some huge losses. So, you know, all these things are great that you read in books and these taglines, you know, that follow the trend and trend is your friend. But it's interpreting that meaning and interpret it for our overall outcome and our you know, what we're trying to achieve. You know, we're not trend followers per se, because we're not looking to buy the low and sell the high. We're looking to identify the trade and the trend, and then identify what's going to make us money. And that can be buying into strength, selling into weakness, but it's all down to that timing issue. So remember, you know, trading with the trend, you know, I do recommend it and it is safe, but it isn't the only way to trade. It's much more of an investing mentality. So what we see here is a sustained bullish trend. So as the market moves up, we know our upside targets, again, that have come from our previous levels, and the lower, you know, targets. So again, from our 50% pivot, yeah, if you're just going to trade from here, you can 100 pips stop, yeah, everything's going to go up to make 140 pips. That's how you can work it. You know, 300 pip, you know, wouldn't really have a stop that big to make 270. But, you know, again, what you're trying to figure out is, you know, you've got upside targets, you've got value areas. So once you've done your analysis, is you can let the markets move around, you know, do what it needs to do. And as it goes to these levels, you can decide if you want to sell these levels or buy these levels. Yeah. But what it gives you is defined points of interest. Yeah. Break points, even bounce or break points, areas of interest, points of interest, whatever you want to call them. But you know that once you've got them and you're in that zone, well, this could move down 100 pips. So I only really kind of need to take a quarter of that move or half of that move, and I'm doing well. Yeah. If it gets down to this level, you know how much you want to take. You know, therefore, where you want to put your stops, because you've got your risk reward ratios. Yeah. All these things are starting to match up when you have these higher time frame levels in. Yeah. You can understand what the trend is, but it doesn't mean that things always have to keep going up, or, you know, have to go with the trend. They can change. But as that framework comes in, you know how to set your stops, you know how to set your value areas. And then all of a sudden, you know, you've got a clearer picture of what you can do in the short term. So again, we're looking at the bigger picture stuff, and it's what happened in the past, you know, can happen in the future. So we've got all our information here. We're zooming in. Okay, we're on our hourly chart, so we can see that this is the kind of value area here. Previous lows, previous highs. So this is our trade. Okay, we've got the previous 50%, so that could be target on the upside. Yeah, we've got the 50% from the hourly, which can be our target on the low side. So the market can break between these two. So if you think it's going to go up, you can put your stop down here, let the market go up and break towards here. If you think the market's going to go down, you put your stop up here, and then the market go down. So again, it's figuring out the right kind of risk reward ratio. If it can go down 100 pips to this point, yeah, then maybe you want to put a stop. It's 2-to-1 trade. So you put it 50 points up. 50 points up above that 50%. So you're hiding your stop up there. Market goes sideways, get down to your profit point, you're out. Okay, so it's all understanding, again, the hourly fibs based around the higher time frame fibs, based around your previous points of interest, giving yourself areas of value, knowing what those values are, and knowing how much of that value do you need for your trading. So you never need to get the high and the low. Yep, the absolute extreme of the move. You're looking for chunks of the move. And by doing it this way, you'll get a better idea of what can be achieved on the time frames you're looking at. So again, looking for that bigger picture type move from this point. Yeah, the market can go up 140 points, or it can down 100 pips or 330 pips. These these next significant points of interest. And again, if you want to do a longer term trader and you think it's going to go down, you got 140 points, kind of stop here. Yeah, to make 300. So if you want to turn a short term trade into a long term trade, who am I to stop you? So the market can go down, break here, break in. You can even average in. So you've got a 330 pip potential move with 140 pip stop. So that's a, almost just over a 2-to-1 trade. Yeah, so you're making double what you're risking. But if you want to be a scalper, you can scalp on the upside, scalp on the downside, because you have your boundaries. You know where the market can go to in the meantime. So again, opportunity, value, rejection. It's just what we're looking for in the markets. Yeah. And again, when you get into this mindset of understanding what's happened monthly, what's happened weekly, what's happened daily, where these points of interest are, what the trend is, what the sentiment is, then you start to look at the market and just think, where's my opportunity? Okay, where's my opportunity to make money? Okay, 50%, right? Market's come down, gone back up, we're at the 50%, right? Well, Steve says if it breaks to 61.8, it's going to go to the next point of interest, 1, 2, 3, 2, 6 up here. Okay, so I'm going to buy it a little bit of chunk towards the top of the Bollinger Band, so I think gold's going to go up. I know what's happening in the dollar, I know what's happening in the world, etc., etc. So you're buying a short-term trade. And again, you're not holding it for hours and hours and hours, days and days and weeks to get here. You're just following where the opportunity could potentially be on the high or the low side, buying into strength, selling into weakness. So again, past levels, future. So again, the quicker the movement, the more people are going to be wrong. Okay, so if you're buying value here, yeah, you can just hold on to the green candles. As soon as it turns red, you're out. You're still making profit. Again, understand points of attraction, understand when the markets are rejecting selling, when they're rejecting high points and low points, figure out the pivots, the all important 50% I've talked about a number of times, and understanding where the market's been, where's it going to go. That's all we're trying to ever do, buy value. So the benefits of this is widely accepted the safest way to trade. So you're going with momentum, you're going the majority of other traders. But again, a lot of contrarian traders, make money by going against the trend. The whole point is, once you get yourself in the mindset of what I keep talking, keep trying to drill it into you, that once you kind of fairly, just even averagely market neutral, and you're searching for value, you'll find that you will have a bias. Yeah, a lot of people will either be bearish bias or bullish bias. Nobody's ever really 50%. I will always just buy, low, always just sell high when I find value. You generally find as a human being, in your nature, you're generally more liking to buy because you've got a positive more mindset and you're more perhaps in, from an investing kind of side or mentality, or you're more kind of negative where you're a little bit more kind of pessimistic about, overbought markets, etc. It doesn't matter. We're human beings. We all get our influences from different things. It doesn't mean it's a good or a bad thing. The only important thing is you identify it. Because if 80% of your trades are buy trades and you make money from, stick to it. Because the one time you hold, a short trade and it wipes out all your profit because you can't get out of it. Yeah, this is the whole point. It's identifying characteristics and traits in yourself, replicating the good traits, yeah, and getting away and eradicating the bad traits. And this is where it's easy, for someone on the outside and a mentor to kind of pick up on these things, because I can identify in your trading things that, you might, kind of look at and just gloss over. It's like anything. It's like, when I wrote my books, etc. I'd read through, paragraphs and I'd see no mistakes. It was all perfect. And then somebody else would read it and say, what's this meant to mean? It doesn't make any sense, type thing. And then you got to go through it and say, well, I've read it so many times, I mean this. So it's the same in your trading. If you do the same thing over and over again, and you're not kind of doing the right analysis or spotting the right kind of traits in your own trading, it's very difficult for you to do anything about it. So really the conclusion for me is, the time frame trading, old time frame trading, is just about plotting points of support, resistance, and really calling them points of interest. What you're looking to do is get that framework and just see where future value could be based upon previous significant points of interest. Again, don't go too far back. I would say start on the monthly charts, go back about a year, 18 months worth of data, and then plot the absolute highs and lows, and again, use your Fibonacci. That's very powerful. Flick into the dailies, flick into the weeklies, find those significant points of interest, get that framework supported by other, other significant technical points. And again, it works on any product. So it's going to work on any kind of, from Bitcoin to the yen. And I'll go through some charts in a minute and I'll show you the markets as they are now. And you know, I'll just show you what it's like to have that that consistency and, you know, a framework that you can put onto any chart. Again, just to remind you, you know, that I'm not a charity here. You know, I'm out here to kind of create some traders and to help people, you know, that already trade to be better traders. And, you know, the services are free. My time is free. But what I do ask you to do is to trade with CMC. You know, they're a trusted broker. The guys that I've met, I'm going to the France New Zealand game with them a week on Saturday. You know, these kind of guys that I know. And you know, I've been the chief market strategist of a trading firm in London for 7 years. They just don't have any operation over here. So again, I've had thousands of traders and, you know, lots of successful traders, you know, in the UK and Europe through Intertrader. But this end of the world, that it's all I've decided to partner with CMC. So if you want to get, you know, the kind of really good stuff, the VIP webinars, that maybe let's just start charging you $2.5 grand for it. You know, would you pay me $2.5 grand for some webinars if you think it's going to make you some money? I don't know. What you got to do is put $2.5 grand in the account, because then you get that physicality. You know, you're putting some live money in and you get the emotions, and you can trade with me and you can see how that's all going to work. If you don't have that, then it's just theory. It's not worth my time. Then you want to be a tier 1, 2, or 3 trader. This is where I really help traders. And the tier 2 and 3 traders is where I've made my, you know, significant traders that have, you know, 20% gains in a month. You know, people that have 6-7 figure accounts, and these are the guys, you know, that trade for a living. They make the kind of big money. So again, you get all the different benefits that come with that, and it's me asking you to invest in yourself. I'm not asking you to give me the money. You're investing and putting the money in your account, because I know if you want to trade seriously, that, you know, between 5 and 25 grand is where you really need to be, and 25 really to $250,000 is where you're going to make significant money. And that's just the rules of trading. That's the way it is. Money makes money. You know, you guys are lucky. You can still trade and leverage over here. You know, the new rules in the UK that come into effect at the end of the month are all down to, you know, ESMA are going to limit people to 30 to 1 leverage. So you can get probably 400 or 500 to 1 leverage, you know, from brokers on this side of the world. So you need less money in the account to make money, but you still need money. That's the whole point. So again, any questions, anything you want to ask, guys, go through it. What I'm going to do is I'm just going to flick over to my my charts. And I can just show you how the markets are moving and how important it is to have your levels. So there we go. You know, we're seeing the currencies move around a lot. So currencies here. So big sell-off in the pound, I guess to be expected, but, you know, the Brexit, etc., etc. So we also see the sell-off in the FTSE. So negativity in the S&P, FTSE stocks, got the DAX here. The inverse correlation will be in gold. So as the stock markets come down, as you know, the dollar goes down, gold becomes cheaper. So we're seeing a big spike in gold. It's got to that 50%. So again, what you can see is, you know, having these benefits of previous levels. So big levels here in the SMI. So as the market sold down, yeah, you could sell down to these points, or you can buy. Yeah. So again, you know, where the market's been in the past, where it can go in the future. Same again. Look, daily, weekly points of interest. FTSE stops just below it. So nothing in the S&P. So that was a bit of a no man's. Yeah. Perfect level in gold. Yeah, 1307.01 to the high, just missed out from touching that level. Again, Fibonacci's here in the DAX. You know, your 50%, your upper points to sell, your lower points to buy. You know, it's all there for you. So again, the euro, as I've said, I never buy the euro low because I don't see any values, but I'd like to sell it high. So as the market, you know, has hit this 50%, look what it's done. It's gone back to your retracement points. Yeah, 100%, 161, 261. Yeah. 428. Market's coming back to these points as it breaks these fibs, gets the low points. Where's the euro going to go below here? Well, the ultimate target, maybe, you know, later on today, or you know, or maybe early hours of the morning, we get down to 1.13759. That's the next logical point of interest, yeah, based upon what's happened in the past. So again, blue lines are monthly, yeah, green lines are daily, slightly darker lines are weekly, yeah, and these are hourly Fibonacci's. So it's higher time frames working with lower time frames. So what's happened in the past? Points of attraction, your hourly 50% Fibonacci, where the market gravitates to as it finally gives up here. Yeah, sell to here, buy money, sell to here, buy money, sell to here, buy money, sell to here, buy money. Market goes up, breaks, sell down here to buy money. And again, you might see it differently. You might say, okay, well, I'm going to buy a bounce here. I'm going to buy a bounce here. Yeah, if you want to buy the euro, that's all fine. But for my analysis, I sell the euro high, and I use my hourly Fibonacci's, and I use my higher time frame points of attraction to see where it can go to in the future. So again, this is iView charts. This is something that I've used for many, many years to trade all different types of products. And, again, from things like even the cryptos, you see the market hits these expansion points, gets to the 50%. Yeah, you know where to buy it back. You know where to buy it back. Again, it's all points of attraction already drawn in for you. So, I mean, if you think, if we just use an example, let's just do like a random chart. So, if you're going to do that whole higher time frame thing that I've just shown you, you'd have to do something like this. You have to start on the monthly chart. So you'd have to get some lines and go, yeah, that's a point of attraction, point of attraction, point of attraction. Okay, weekly. Probably change a different color. Can't be bothered, I'm too lazy. Point of attraction, point of attraction. Then your dailies, point of attraction. And then go into your hourlies. Okay, and you got your framework. Okay, so you got your framework. So if the market breaks up here, it can go to there. If the market's going to reject this, then it's got all the way down here to go. So that's very kind of a crude way of doing it. Or what you can do is just go into iView charts and do that. All of a sudden, you got your framework. You got your 50%. So the market's broke above it. You've got your resistance point. The market breaks above here. It's going to get to this level here. Okay, 1.34898, which is a daily and weekly point of resistance. That's how easy it is. So you can chart in under a second. Yeah, so instead of doing all that manual work, you have all the algorithms work for you, give you that framework, and that's what saves you the time. That's what gives you the consistency, because you just can then drag any product you want. So you open up and think, what else do we want? Aussie, New Zealand dollar. Drag it in. It's going down. Where's the 50%? There it is. Points of attraction. What else we've got? Euro, Japanese yen. I thought that's a messy one, isn't it? Didn't like that, did it? There we go. Euro, Japanese yen. Where's that 50%? Here it is. All the lines. Future points of attraction down here. So, again, it's all about, just kind of dragging things in, testing them. And you can set this up on any kind of chart you want and anything that interests you. But again, the formulas run based on previous movements happened in the past, and you can always get a good picture. So, like I said, I mean, if you open up an account, I'm more than happy to share my charts with you, share my mentoring experience, help in any way I can. But at the end of the day, you've got to kind of make that decision, make that plunge. You're ready to, trade your own money and, get that mentoring, get that support, then that's down to you. I can only take you part of the way there. A lot of people in trading are people that just like to talk about it and like to listen to free webinars and, don't really have any kind of real balls to go out there and do it for themselves. And that's just the way trading is. People think that they have to learn forever, and by the time they've learned, the markets have changed. You only really learn by doing things, for real. It's the difference between going to the driving range and hitting 100 balls and then taking 5 balls out, around 18 holes. Yeah, you only get those balls, and when they're gone, they're gone. All right, guys, any kind of final thoughts or questions? So deposit requirements from CMC to access your service are quoted in New Zealand dollars. I mean, I go across a few jurisdictions here, so I'm generally just talking, I'm talking about being serious. So if you want to be serious about these things, just tell me the amount of money that you're willing to kind of trade with. I'm not looking for, necessarily a minimum. But, if you want to come and say, I'm going to trade $1,000, well, $1,000 in any amount of money isn't very much. So as long as it's a reasonable amount of money that's going to buy you some time in the market, then, I'm willing to give some time to you. So I would just say, contact me directly. We can talk through your requirements, and we can start at certain levels. We can build it up. Again, it's just more of a guideline for people that are actually interested and want to, move forward, to come to me, rather than just getting 100 emails every week of people saying, oh, I put $50 in, can I get this? And can I have an hour of your time mentoring? It's not, we're talking GBP, what I'm, kind of worth. I'm £500 an hour if you want to buy my time. So, I'm not going to, give you an hour of my time if you're just going to put $50 in the account. I'm looking for serious traders that want to make some money here. Does my methodology change because MT4 isn't compatible with CMC? Well, it will be compatible with CMC. CMC are launching MT4 in the next kind of few weeks. But what you can also do is you can trade off the charts and the patterns, and then trade on the spread betting platform. So it doesn't make any difference to me. When you're a professional trader, I charted on CQG, but I traded through TT. You don't necessarily need to chart through where you trade. Yeah, you can have your execution through one broker, and you can chart on another. Again, there might be some discrepancy on prices, but it's so minimal these days that it doesn't really matter. You can do your setups from that. And as I say, in the next kind of few weeks, CMC are going to be launching cryptocurrencies, and they're also going to be rolling out MT4 as well. So yeah, it doesn't make any difference from that respect. What about drawing trend lines? Yeah, well, I went through drawing trend lines. I mean, that's just looking from what happened previously in the markets and the different time frames. So again, it's just making the charts work for you. It's understanding the correlations. I've said this to you before in many webinars. Everything's kind of linked in a certain way. So as the stock market's coming down, risk off. Yeah, people are getting risk on with gold. So as kind of the risky investments come down, yeah, people are getting out. Yeah, people are getting back into safer stocks or safer havens. That'd be like things like your Swiss, your Norwegian krona, and things like gold. So currencies. Yeah, this is weird because all the currencies are moving down. Yeah, so as the euro's coming down, the pound's coming down, the dollar's also coming down. Something's got to give. So the dollar's either going to snap back up, or the euro or the pound's going to snap back up, because these can't all move in the same direction. Yeah. So again, it's picking up your currency coefficients, your correlations, your wider market sentiment, picking up your data. And it is, it can be confusing. But once you start with a higher time frame, mentality, and you can plot a chart, any chart from that monthly to daily, and then trade in the hourlies, you're going to be fine. All I'm saying is, if you don't want to spend, time doing that, then there are systems like mine that can help save you some time. That's all. It's just a time saver. All these things can be done manually. Okay, guys, any other final thoughts? Any other final questions? Mindful that I've been on for an hour now. I don't want to bore you guys to death. Like I said, I'm going to continue these webinars every Tuesday at 8 p.m. NZST. Going to go over my educational topics, and then I'll go over different, kind of scenarios in the markets. And as the kind of educational dries up, because it doesn't last forever, I'll move much more into kind of going through data, going through market scenarios, trade ideas. These early stages, I'm trying to build the numbers up, to be honest. So again, advertising is quite expensive. It's costing me $50-$60 to get somebody on a webinar. So if people are interested in trading, forward my email, forward my site, steveruffley.com. Get some people on there, get it interesting. Because I'm not going to keep doing free webinars, to be honest. If people don't, kind of want to turn up and don't want to kind of sign up, I'm not wasting my money for the sake of it. I'll just keep trading for myself, So like all these things, we'll trial run them and test them. But as I said, I'm not a charity, so we need people to be in the rooms, on the webinars, trading. Getting some interesting questions back, because that's how everyone helps. When I go back to my intraday webinars and there's hundreds of people on, that's where you get the buzz. That's where, the most kind of creativity for me comes from. And I know this is early days, and I'm willing to kind of give it, as much time as it needs. But yeah, any help you can do by sharing me on social media, on Twitter, getting the good word out, I'll keep turning up and keep doing this good stuff with you. All right, guys. Well, like I said, Baz or Owen, if you want to kind of get some stuff going and you want to kind of talk to me, just email me, Steve, steveruffley.com. And we can just sort something out. Again, as I say, there are no major restrictions on anything. I just don't want time wasters. That's all. All right, guys. Well, I think that's me done for tonight. I hope you enjoyed it, and I will see you the same time next week. All right, guys. Take it easy.